All right, well, that leads us perfectly into Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, so you were already talking about this, JPMorgan, and any wonder it is your first pro pick. So you said that you liked it for dividend growth, relative outperformance. I guess the question is, how do you think about how much further it can rally from here?
Right. So I always take the lens back, right? I'm a big proponent of looking at long-term price charts. And when a sector has underperformed for a decade and starts to perform, or 15 years in the case of financials, that's the beginning of something. And it doesn't mean it's going straight higher, but it probably means you have a decade in front of you of strong returns. When I pair that with the shift in interest rates that happened in 2020, again, there's going to be rates will move higher in fits and starts, but they likely move higher for the next 10 to 15 years. And so if you think about it, the biggest winner in that world is that the power is in the hands of the lender to get paid for lending money and to being in the center of monetary transactions. So yes, it's been a great performer, but you think about what happened to NVIDIA in the 10 years that tech was leading, or what happened to Cisco in the 10 years up to 2000. You know, the leader continues to lead. So portfolio managers are human too. They have people they report to. They want to own quality in their portfolios. Nobody's ever getting fired for owning JPMorgan, right? So I think they are going to continue to be a leader with or without Jamie Dimon. They've got an incredible franchise, and it's very hard to beat. Every time another bank gets into trouble, they get shepherded into JPMorgan's hands and they make more money.
So JPMorgan is down about 10% from its most recent all-time high. And you said part of your discipline is you've got stop losses that mean you would roll out of the stock because it's hit that target. So we've pulled back 10%. At what level would you come out?
Right. So we're big believers in wanting to see the securities that we own make higher highs and higher lows. And if you take a look at JPMorgan's share price since the market turned in August, it actually put a low in before the market did in October of 22. It's made nothing but higher highs and higher lows. So I think that if the stock was to trade kind of below 236.
It's 250 right now.
Yeah, we would probably be going to the sidelines. You have to keep in mind that every stock has its own personality. I use point and figure price charts to help understand change points where something goes from making higher highs and higher lows to lower lows and lower highs, uptrend versus downtrend. I want to own a stock as long as it's been in an uptrend and that it continues to be good, getting better, where the financials continue to support our view, the technicals support our view. We like to have the sector wind at our back. All of these things are in line here on JPMorgan.
Okay, so let's see how that applies to your second pick, which is Fairfax Financial, also a stock that has just run so massively, making new all-time highs after all-time highs. What are the catalysts you think here?
So look, when you buy a property and casualty company, you're buying an investment portfolio, right? Like the reason people buy Berkshire Hathaway is because they've done a marvelous job taking the float and investing it and generating a return in excess of what they have to pay out to their claimants. And Fairfax is the same. It's just a lot smaller, right? Prem Watsa has done an amazing job in building out his firm, and they've made great investments. The percent of their return that comes from dividends and interest continues to grow, which is very safe, right? Their return on private company investments have been pretty good. But as a business, it's growing more quickly than all of their cohorts. There are about 10 big companies in property and casualty. This company is growing faster than all of them and trades at a discounted price to almost all of them. So we're paying.
Even though it's at an all-time high, let's underline that. You still say it's trading at a discount.
Their investment returns are great. Their growth in writing policies is great. The payout ratio is pretty good. And the thing about property and casualty is when there's a bunch of disasters like there were last year, it means that the insurance companies have a sort of a license to harden their prices, which means they raise the price of your auto insurance, right? We don't like that. I would like to own Fairfax and offset the increasing cost of my auto insurance, especially for my kids. So look, Fairfax has been a great performer now.
And I think people call Watsa sort of the Warren Buffett of Canada, and the stock's actually done better than Berkshire.
It has. So we've owned this stock twice. This is the second time, and it's been our top holding for about 18 months. The first time we owned it was when my ex-partner joined the firm. We owned the stock from $16 to $600. These companies, when they get going, can go a long way.
$16 to $600. So when did you own Fairfax this second time? This is in
the way back. So we've owned it for about the last 2 years.
2 years. Okay. So you've seen a nice run, more than a doubling.
Yeah. But look, it continues to execute. And the financials are a tailwind sector.
You've talked about your holdings in gold, and Agnico is one of those holdings that you have. It has been, on a relative basis, outperforming some of those others senior producers out there. Why do you continue to like Agnico?
Look, this is a company, if you were going to own one gold stock, this is probably the one you would buy. If you think about it, they are geographically diversified. They have 11 different mines, so they're not dependent on one. A single mine company can do very well, but you can lose a lot of money. They have a long history of execution. Being an operator in this industry is really hard, right? Because it's variable conditions when you're mining, and being able to operate consistently is not common. It's a company that pays a dividend and has for 40 years. It's a company that's growing its cash flow quite dramatically, and it's an institutional favorite because this is a relatively large cap company at a $70 billion market cap, and it can go into any portfolio, and it's liquid. So I think that this is a company that somebody could have a 3, 4, 5% weight in their portfolio and cover off gold. I would probably own a little bit of physical gold as well. And again, we're not gold bugs, but there's a time and a place, and this is probably in the sweet spot. So
already close to all-time highs. So is gold. How much more could it go? Does it need to see bullion prices continue to advance?
Yeah, so that's a great question. So keep in mind that a lot of the bullion advance has not been investors. It's been central banks. Yep. There's that old line, don't fight City Hall or don't fight the Fed. Like, central banks around the world are buying gold. And so we have to keep that in mind. Retail investors have really only just engaged. In the last 2 weeks, there have been fairly sizable flows into gold itself through ETFs. And the producers have really underperformed up to this point because everybody knows you'd be an idiot to buy a gold stock. Well, I understand that because, we went through a bear market from 2011 to 2021. Nobody made money, so why would you put money there? It takes time for people to catch on. And when this stuff starts, if you've looked at cycles over time, it might happen 2 or 3 times in the course of your life. There's an opportunity here. So look, it's about 80% above the long-term moving average. If you go back to the last bull market, it regularly, 3 legs higher, got stretched 150% above the long-term moving average. So you could see the stock go up a bunch from here and be just similar to other previous gold bull markets.
All right. Fascinating stuff. Thank you so much, David Burrows. I think we help people make some money in this episode.